All right, today we're pulling back the curtain on something pretty wild, the world of high-frequency finance. We're going to get an inside look at a team of AI trading systems, a setup they call the Hunter Protocol. This is what automated algo trading looks like up close.
So, get this. On September 10th, this system had a perfect day. I mean, not a single losing trade. But here's the thing about the markets. Yesterday's home run guarantees absolutely nothing for tomorrow. So this is the story of what happened next.
Okay, so to really get what's going on with this protocol, you first have to meet the team. And just to be clear, we're not talking about people in suits here. We're talking about specialized AI systems where each one has a very, very specific job to do.
Think of it like a digital special ops team. First up, you've got AlphaCore. That's the hunter. This is the AI that actually pulls the trigger and makes the trades. Then you have DOTAS, the analyst. Its job is to be the eyes and ears, constantly feeding market intel into the system. And finally, you've got Omni-Profit Nexus, the validator. This is the commander, the one who makes sure everyone sticks to the plan and follows the rules. Every single one is a critical piece of this puzzle.
So, to really appreciate the massive challenge they're about to face, let's just rewind for a second and look at what they just pulled off. The day before, September 10th, was about as close to a perfect trading day as you can get.
100%. Let that sink in. Across 9 different trades, the system had a 100% win rate, not a single loss. In the trading world, a perfect day like that is, well, it's practically a unicorn. It was just a textbook performance.
And listen, we're not just talking about tiny little wins either. This whole system is built for what they call high-convexity gains. Basically, it's hunting for those explosive outsized returns. On just one options trade in Tesla, it locked in a gain of over 133%. That's the kind of aggressive power this protocol is designed for.
But here's the crucial part, and the system's own internal report spells it out. This wasn't just about getting lucky. As Omni-Profit Nexus put it, this was a textbook validation of discipline. The AI did exactly what it was told. It managed its risk, it honored its preset limits, and it took profits when it was supposed to. So the big takeaway is this success came from a super rigid framework, not from some kind of reckless gamble.
But you know how it goes. After a perfect day comes the next big test. The system now has to get ready for a major economic event, the kind of thing that can send huge shockwaves through the entire market.
And that event is the Consumer Price Index, or CPI report, which drops at 8:30 a.m. Now, for the markets, this is a huge deal. It's the big measure of inflation, and any kind of surprise, high or low, can cause prices to just go wild. For an automated system, this is a moment of maximum danger and, of course, maximum opportunity.
Now, to really understand the environment here, we also have to talk about the VIX. People call it the market's fear gauge. Before this report, the systems were operating with a low VIX, meaning the market was pretty calm, maybe even a little complacent. But that CPI release, it threatened to send that fear gauge spiking, injecting a massive dose of uncertainty into everything.
So, how in the world does a team of algorithms get ready for something like this? Well, in the pre-market hours, before all the chaos kicks off, they meticulously build a digital game plan. And just like any good strategy, the plan has 2 sides. You've got your offense, which is the primary positions, aggressive bets on the S&P 500 or SPY, plus Tesla and a Bitcoin ETF. All designed to score points. But then you have the defense, the risk protocol. That means clear triggers for hedging against volatility, hard stop losses on every single position, and the ultimate failsafe, a kill switch.
Okay, this is basically the AI's brain on a slide. It's a live tactical trigger map. The system isn't guessing or getting a feeling about the market. It's running on a predefined set of if-then conditions. If SPY goes above this price and the VIX is below that level, then it buys. If the opposite happens, it sells. Every single action is pre-planned and calculated.
And then there's this, the ultimate defensive move, the kill switch. If the market absolutely melts down, and it defines that as the S&P 500 dropping below 640 while the VIX skyrockets past 18, the protocol hits the big red button and immediately flattens all positions. It just gets out of everything. This tells you that above all else, the system is programmed to preserve capital and survive to trade another day.
So, the game plan is set. The rules are approved. Now comes the final stage, execution. Let's walk through these last few moments as the Hunter Protocol gets set in motion.
This timeline shows you just how incredibly disciplined this whole thing is. The orders go out at 7:15 a.m., the Hunter Protocol is officially engaged. But look at the most important part. At 8:30 a.m., right when that CPI data hits and the market goes crazy, the protocol's #1 rule is no trading. It actually waits for 2 to 5 minutes. It lets the first wave of human panic and algorithmic chaos just wash over the market. Only then, after the dust starts to settle, does its main execution window open. It waits, it watches, and then it acts based on its map. It's pure, cold, calculated patience.
And this really brings us to our final thought here. When you see these systems operating with a level of speed, discipline, and raw data processing power that no human could ever match, it leaves us with a pretty critical question for the future of finance. In a market that's more and more dominated by these automated hunters, what exactly is the role of the human trader?